Welcome to the Daily Insights That Matter. Now, in the recently concluded two-day Federal Open Market Committee meeting, or the FOMC meeting, the US Fed has decided to maintain the benchmark interest rates at the current level of 5.25 to 5.5%. Now, this means that they have kept the rates unchanged. Now, this decision was largely anticipated considering that the Fed had already increased its policy rate by substantial 525 basis points or 5.25% since March 2022. Now, it's noteworthy that there has been some improvement in inflation data recently from a 41-year high of 9.1%. However, the inflation rate still remains well above the Fed's target of 2%. Now, the real news here lies in the projections made by the Fed officials as they indicated a likelihood of raising interest rates once more later this year. Now, the Fed officials have meetings scheduled in early November and mid-December to take this call, which means to say that they have continued to keep a hawkish stance. Furthermore, they plan to implement rate cuts more gradually in 2024 and 2025 compared to the earlier expectations. Notably, the Fed chair refrained from making any sensational statement. His primary message was that while the Fed is pleased with the recent progress on inflation, it's not ready to declare victory against inflation yet. Now, the Fed is keeping its options open and monitoring the situation carefully. By indicating another potential rate increase this year, the Fed is staying flexible in its approach. While inflation is showing signs of cooling down, there are still risks that could lead to prices rising too rapidly for comfort. In summary, the Federal Reserve's decision to keep interest rates unchanged was widely expected, but the real interest lies in their future projections. While inflation is showing signs of cooling down, there are still risks that could lead to prices rising too rapidly for comfort. By indicating another potential rate increase this year, the Fed is staying flexible in its approach. The Indian benchmark indices are currently going through a rough patch this week, seeing their steepest decline in a day by over 1% on Wednesday in over 2 months on the back of various factors. Let's look at these factors. First is the crude oil prices, which have been on the rise over the past few months on supply deficit concerns. In July, Saudi Arabia had made a significant move by reducing its daily oil production to 9 million barrels, in addition to the 1.66 million barrels that OPEC plus countries had already cut earlier in the year, with 500,000 of those reductions originating from Saudi Arabia alone. Additionally, recently, Russia and Saudi Arabia decided to extend their oil supply cuts for the entire year of 2023. Now, when two of the world's largest oil producers make such a decision, it's undoubtedly going to have far-reaching implications. Rising crude oil prices and a widening current account deficit are weighing on the market, adding to a decline in the market indices. Second is the HDFC and the HDFC Bank merger. The two powerhouses of the Indian financial sector merged on the 1st of July with HDFC Bank as the final resultant entity. Now, though it created a lot of buzz in the market earlier, the bank indicated a potential negative impact of the merger of HDFC Limited on its key financial ratios like net interest margins and surge in bad loans, affecting the asset quality, which led to the worst fall of approximately 4% for HDFC Bank since the merger became effective. Now, this led to a few broking firms like Nomura even downgrading the rating on the bank. Moreover, the bank has the highest weightage in the Sensex as well as the Nifty, and a fall in this particular bank stock would lead to an overall drop in the major indices, and that is exactly what has happened. The third is the US Fed's hawkish stance. The US Fed's decision to continue its hawkish stance on the interest rates impacted the indices as well. Now, the market indices saw a decline this week on the back of crude oil prices nearing the $100 mark, coupled with HDFC drag and the US Fed's hawkish stance. Now, the fluctuation in crude oil prices has substantial implications for countries like India, which heavily rely on oil imports to satisfy over 80% of their overall oil requirements. Now, rising oil prices coupled with goods trade deficit hitting a 10-month high in August put pressure on the rupee, and this did drive away foreign investors from investing in the Indian markets. Furthermore, the hawkish stance of the Fed and the index heavyweight HDFC Bank added to the decline and has resulted in the broad market indexes in red. With that, this is Raj Mehta signing off, wishing you and your loved ones a very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
you.